Alright guys, what's going on? We're going to be doing a liquidity session today. What's wrong with my hair? But yeah, this has been a requested video, to be honest, by like two people. They don't really know what liquidity is. And I'm being so real, I don't even use liquidity that much anymore, the concepts of it. Break and retest is just so simple, like it just cuts out the BS and like you can just trade it. If you're a break and retest trader, you don't really need to watch this, but you can if you want. I mean, it helps kind of. But anyway, let's just get straight into it. So the market, right? It moves in two ways. So the first way is stop rates. Second way is rebalancing to inefficient. By the way, don't mind my spelling. I can spell. It's just can't be. So the first way is stop rates. Okay, the stop rate. I don't want to call it stop rate actually. It's just liquidity grabs. Okay, it's just liquidity grabs. Okay, liquidity grabs and rebalancing to inefficiency. These are the two things, the only two things that the market does to move price. Okay, the only two. There's no other. There's no other way. So look, the first way, yeah, is the liquidity grabs. So let's get into it. So the market, right? It always needs to grab liquidity before it can actually move. Okay. So look, let's just go over it. The first way I'm going to explain to you is just the bullish liquidity sweep. So we can see here, right? What can you imagine? You can imagine right here that people would be drawing their little trend lines, right? You can be imagining that they'll draw their little trend lines, their support and resistances, and this is just like the classical retail strategy of where their stop losses would be. So people would be trailing their stop losses here, 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 as you can see. So you can tell that there's just money there. There's people's liquidity, their money, their stop losses are there. So what does the market like to do? It likes to just go down there, hunt it as in take out their stop losses, take out the money, take out the liquidity before it can move in the true direction. So I'm going to be showing you a series of liquidity sweeps so you can see, and so it's good for your eye training so that you can notice it. So look, price goes here and liquidity sweeps this low specifically, okay, because there's stop loss orders here, okay. You can see how perfectly it just comes and sweeps it, takes these guys out to the tick and then reverses to its true direction. And that's example number one. Let's go for number two. Over here, what do you see? A nice classic support and resistance model. One tap here, two tap here, three tap here, okay. What does price love to do before it has to move in its initial direction? It loves to take liquidity. What do you see here? There's a bunch of orders and stop losses and liquidity below here. Why? Because look at this impulsive move. People put their stop losses below here and their TPs above here, right? You can imagine that. So before price can actually move in its initial direction, what it wants to do, what it likes to do, it just takes out liquidity. So what does it do? Perfectly to the tick, it just swipes them out and then continues in their direction. This is nothing made up. You can see it for yourself in your chart as well. Okay, let's go to the hourly. I like the hourly a bit more. It's more cleaner. Already showed the example. Look here. This is a more shorter time frame one, but regardless, look, price is at, bear in mind, it's at a really high point, okay? Where was that all-time highs? Maybe, but it was really high. We wanted to move lower, right? Obviously, because you can see now on the hand side, we were really high. We wanted to move lower. What do we need to do? Remember what I said. We need to grab liquidity. We need to grab liquidity in either form. We need to do a liquidity grab or sweep, okay? So what do? We manipulate this high on purpose for it to later be swept. We put in this high, we generate this high on purpose for people to put their stop losses up here, okay? And then we do that on purpose for it to be swept later. This is for money, for liquidity. So you can see it was generated and then later on swept. You can see that the body didn't close above, it was just a wick. It just shows you how institutional it is. And then what do we do after that? Dump, fully dump. Keep on dumping. Look, we can just, it just needs this liquidity to move, okay? We can see another direction, another sweep right here. I think this is just about one. So look, induced this high, made it on purpose just so people with their stop losses above. As you can see, it fakes and then comes all the way back and then sweeps these guys out. Okay, boom. Why is it so perfect? Just ask yourself, why is it so perfect that it sweeps the high and then dumps? It's literally because it needs the liquidity to move. It needs liquidity to move. Let's find some other examples. I think there was one right here. This one is so perfect. Okay, so look. It generates this low, okay? Generates this low for it to later be taken, okay? In fact, bro, there's literally 3 sweeps right here. Okay, so look. It goes up, okay? It comes down, retraces to the 50% mark. People put their stop losses here because they like to buy around here. Here's a fib level, okay? They like to buy here. Their stop losses are here, okay? So what does price do later on before it needs to move higher? It comes and sweeps these guys out. Sweeps them out to the tick. Their stop losses are gone. Then market moves to its initial direction. It takes out the next draw on liquidity. Okay, what does price do? It wants to take liquidity again before it can move higher. What does it do, man? Sweeps them, okay, and it instantly rejects from this level. Look how many points it moves up. And then, as you can see, it fails to displace, so it needs more liquidity. It just needs more and more and more, okay? So look, comes all the way down here, sweeps these guys out. And then after that, after it's satisfied, then it moves to its initial direction. It just fully, like, pumps, alright, to the moon. Yeah, and then it reaches its highest point, liquidity sweeps and dumps. It's just everywhere, guys. You guys need to backtest this, forward test it, and see how, like, you just need to keep on eye training, okay? Just keep spotting out like I am, and with practice you'll be better. Okay, so as you can see, that was literally how the market moves. Okay, that's the first way. Second way is through fair value gaps. I like this one. Fair value gap is literally just a gap. Okay, look, let me show you. It's a 3 candle formation. Wow, there's actually a lot here. So you can see the first candle, the wick doesn't go above the body, right? And then the third candle, the wick doesn't go below the body. You see this point right here. This is the fair value gap. It is inefficient price. Inefficient price, why? Because there's no selling pressure here. Because no wicks came down here. No wicks came up here to fill it. There's a gap and it needs to come back. Price needs to come back and fill it at some point. Some point it has to. Okay, so it forms these inefficiencies and then it comes back. Coming back, this basically takes liquidity. Why? Because there's like inefficient price. Alright, so we can see here a fair value gap was formed, came back, rejects from it. Do you see how it rejects from it? This just tells you that it's a liquidity point. It tells you that there's a lot of liquidity there just because it rejects from it. And there's another example right here on the left, a bearish one. A bearish fair value gap was formed. Okay, price trades lower, trades back into it. In fact, it trades back into it twice, man. You can't make this stuff up. Comes back into it, rejects, goes where it needs to go, comes back into it again, rejects for more liquidity, rejects, and then goes where it needs to go, and then that liquidates it. Like, it's just so perfect. Let's see on the weekly. Yeah, on the weekly, look, fair value gap, spot it for me, man. Look, right here, boom, right here, boom. That's the gap because it's inefficient price. What does it do? Fills it to the tick. It fills it to the tick, okay, and it rejects from it instantaneously. And it rejects from it. You just see how perfect this is? These are the 2 ways which price moves. Okay? 2 ways. It hunts liquidity, hunts and generates liquidity. Look, by the way, the fair value gaps happen on every single time frame. The lower the time frame you are, the less probable it is. By the way, that's why I like to trade. Well, I don't do it anymore, but when I used to trade higher time frame gaps. Okay, look, let me just find you some. Right now, it's just inefficient price, but look, there's one right here. A gap, boom, gets respected twice and then flies. By the way, also, you know, some people trade inversion fair value gaps. So you see a bearish fair value gap right here. Okay, so people wait for price to break above it, and then once it's broken above with candle wise, like this one, you wait for a retest into the zone, and then you take your long. Okay, stops below the IFG or the next low, which is right here, and then boom, that's your trade. Okay, 2R or whatever. Okay, but yeah, for those broken research traders and basically like myself, you don't really need to use fair value gaps in these liquidity concepts, but it's good to know, I guess. I don't use it anymore just because you don't need to. Basically, with breaking retest, you just follow the trend. If it's up, you go up. This is that simple. It's literally that simple. You don't need to overcomplicate it. You don't need to look, oh, look at this, it's bearish. No, you just look, it's bullish, and you keep on following the trend, the current price. What I like to do is look at the past 3 candles and then go to the hourly. In fact, look, it's literally Monday. It's 11 o'clock almost. Let me just show you what I'm looking for. Okay, so I look at this structure on the weekly, breaks past, gets tapped back into, liquidates this low, very nice and bullish. Okay, I know that we're bullish. I look over here, we can see this high gets broken past, and this fair value gap overlaps, very clean. It gets broken past, and now it's getting tapped back into as we talk. So this is just it's a really nice, it looks like a really nice setup. Now what I'm looking for, what's the time? It's 11, okay? I have an hour until I can trade. I trade at 12 onwards, okay? So because I kind of missed this move. I didn't miss it, but I just don't trade these hours. What I'm going to do, I'm going to mark up this zone right here. I'm going to wait for it to be broken, and hopefully around 12, 11, depending if there's news or not, I'll take this trade. So it will break past it, it will tap back into it. Let me just mark it out with my path tool. So it breaks past it, taps back in, rejects a bit, shows some depletion, makes a chotch on the 5 minute, and then that's my long. Okay, that's my trade. That's what I'm looking for today on the Nasdaq. Let me check US 30 real quick. US 30 obviously bullish on the daily. Okay, and then market our structure, which got broken and then broken again. Yeah, I don't think I'll be trading US 30 today just because of how it looks. So we broke past this level, okay, with displacement, and then we just came back down. I don't know why. Unless it goes up really nicely and breaks this structure, then maybe I would potentially look for longs. But yeah, other than that, I'm probably gonna stay away from US 30. NAS looks really clean. But yeah, guys, hopefully that was a good video. It was kind of long, but hopefully beneficial. And yeah, I'll see you guys